Good morning, everyone. I don't have my gavel, so I'll have to just bang my fist instead. Welcome to the Foreign Correspondents Club of Japan. I'm Anthony Rowley, a former president and head of the task force that arranges these deep dive events. Let me right away introduce in these events we invite panels of experts to discuss topics of current interest. So let me introduce our speakers right away in the order in which they'll be speaking. To my right is Naomi Fink, who is Chief Global Strategist at Omova Asset Management, which of course was formerly Nikko Asset Management. And joining us from Washington, D.C. is Hong Tran, who is a non-resident senior fellow at the Atlantic Council in Washington, a Geoeconomics Center, and a former official of both the IMF and the Institute of International Finance, IIF. To my left is Jesper Kohl, a veteran, renowned financial analyst, and nowadays expert director at Monex Group and an investment committee member of the Japan Catalyst Fund. Okay, well, we've called today's event Japan at the Center of a Bond Market Storm. That might sound a little bit melodramatic, you may think, but the danger of a storm is there if PM Takaichi should choose to employ her formidable political clout in the wake of her recent lower house election to embark upon risky fiscal and economic expansion plans. I think financial markets are certainly somewhat nervous at this prospect right now. This is especially true of the Japanese government bond or JGB market, in the view of at least some analysts. I'll just say briefly, as the Institute of International Finance noted in a recent commentary, quotes, Japan sits at the intersection of global savings and global duration, and even small changes in its bond yields can have outsized effects on global portfolios. The Trump-Takaichi duo, he said, could spell turbulence ahead in this regard. And Hiroshi Nakasawa, who's a former deputy governor of the Bank of Japan, recently stressed the importance of fiscal sustainability. He said, and I quote, overseas investors tend to assess Japan's fiscal position more strictly than domestic investors. Japan's government debt to GDP ratio, he pointed out, at around 250% is exceptionally high by international standards. While rising tax revenues mean that an immediate downgrade of Japanese government bonds is not imminent, market perceptions can change with alarming speed. So with that, I'm going to hand over to our first speaker. Just remind you, if you've got a Keitai-den or a mobile phone, switch it off or put it on manner mode, please. So, Naomi-san, if you would begin.
Yes, thank you very much for the kind introduction and also the invitation to speak to everybody today. I am centering, given the topic, the bond market as the protagonist of my remarks today. So my presentation, as you see, is called It's Not Easy Being the 40-Year JGB. And I'm going to talk about, I know there's been an election, but we're still going to focus on the bond market in my remarks. I'm going to talk about why the 40-year JGB may have seen as a type of canary in the fiscal credibility coal mine, maybe a larger than life projection here that affected the 40-year JGB as well as some of the other near durations. Here we go. So first of all, let's review what happened, and this was prior to the election. We had some movements in the longer end of the curve. So we had the 30 and 40-year JGBs, the yields rising sharply, and simple yields going to levels that we haven't seen in quite some time, then retreating again. What was the trigger? It was apparently the decision to dissolve the lower house for a snap election, and we've had that since. and then also talk of a temporary consumption tax suspension, at least for food. When the market received the news that the LDP was not unified on this cut, then the yields retreated again. Now, what was actually unusual about this? The swings in the 40-year are not that unusual. Why? Because it's a very illiquid, it's a very small part of the JGB market, and it's a very illiquid part of the curve, and typically it is the dominion of life insurers. Recently, life insurers haven't been buying as much as usual, and there's been a greater number of foreign investors investing in that maturity. Notwithstanding, it is a very small and illiquid part of the curve. Now, the other unusual thing is that although we can't prove that there was some type of contagion, what we did have is an apparent reaction, at least from the U.S. bond market, and then that was very unusual, especially because the U.S. bond market is much larger than the JGB market, and certainly much larger than the 40-year part of the curve. So I guess we could say we had a viral moment, not in the contagion sense, but in the market meme viral type sense. And then there was actually commentary, there was reaction from Japanese and overseas officials, including the US Treasury Secretary. So it was really kind of an attention amplification going on. Not necessarily financial contagion, but still we can't dismiss it as in terms of market impact. So by global standards, this wasn't really an egregious move. And if we take a look at what's been going on in rates on the left-hand side globally, then we can see that the Bank of Japan is the outlier. It's been hiking rates gradually as the rest of the world has already hiked and now has been well entrenched into a cut cycle. So the contrast is very clear. And if we take a look at the moves in the relative bond yield curves on the right-hand side, even though we have seen some steepening in the JGB yield curve, it hasn't really been out of the ordinary. In fact, if we take a look at the shape of the US yield curve, then the shape of the US yield curve appears to have changed quite a lot more, a little bit less in Europe, but still, similar trajectory. So I'm not really sure what we had was anything truly egregious, and it certainly wasn't any type of crisis, especially since we've seen some successful, at least well-covered bond auctions since then. So now let's take a look at Japan's fiscal situation. Do we have a crisis, and has the fiscal situation worsened? Well, not really. In fact, it's improved over the last few years. Debt to GDP recently peaked, and the primary balance is at or at least near surplus, and that has been a goal for many years. So there doesn't really seem to be any trigger for an immediate crisis right now. And meanwhile, very importantly, and this has been featured in many media outlets, Japan has a very healthy current account surplus, in contrast to many countries, including the US, who have current account deficits. And I've outlined that on the left-hand side. We see clearly delineated the current account surplus countries versus the current account deficit countries, the major economies. So then that's also not sending a warning signal. On the right-hand side, though, what we do see is something that's very helpful for both the macro and the micro, and this is real rates minus real growth. We have that in negative territory, so that means conditions are very, very accommodative. So they're very accommodative for firms and households, but they're also very accommodative for the government. So we're not having an immediate funding crisis because of a spike in interest costs. Could that happen someday? Maybe, but we're not there right now. So, of course, the central bank, the independent central bank knows that negative R minus G isn't a permanent scenario. And in the models that they've explored, and these are DSG models, they're typical central bank models. We have seen some idea of where neutral rates may lie, and that is clearly above real rates today. At the low end, if we add 2% inflation, we get to somewhere near 1% rates. And at the higher end, it's higher from there. And the same is true for the longer end of the yield curve. Although if we see both the R star and the short end materialize and the equilibrium interest rates on the right-hand side here, then we have some type of pretty flat yield curve. So that's what at least in the model we should have an equilibrium. But I think the main message is that R minus G is ultra low right now, ultra accommodative, but it cannot last forever. And as Japan reflates, we shouldn't expect it to last forever. So going back to the long end of the JGB curve, what did we actually see? Not a panic. Long bonds don't really panic, but they do reprice incentives. What incentives? So first of all, what's at stake globally? From a market's perspective, if we take a look at what's really out of whack, I mean, we did see the current account deficits and surpluses compared to each other. But if we take a look at the value of the yen, and it's not the only currency, but it's probably the one of the major currencies that's very clearly cheap by almost any measure. So long term, I think I've mentioned this before, purchasing power parity is somewhere near 100 yen to $1. So we're very far from that. It just gives you an idea of how cheap the yen is. If we take a look at a shorter term model, kind of an uncovered interest rate parity type model, then we get closer to where we are today, but still we get levels in the 140s, not the 150s, so we're still cheap. And so what has been happening, what's been elemental in driving this? Well, there's been a lot of funding in the yen and investing in various risk assets. And we see this in flow data. And on the right-hand side here, we have BIS flow data. And I use this because this is cross-border claims. And it shows a surge that significantly predates this bond market situation. It's been going on for quite a while. I guess this is one aspect of the yen carry trade. So going back to the question of incentives. So when I say that really it's an incentive problem and not really an immediate fiscal crisis problem, what I'm talking about is fiscal credibility. Fiscal credibility matters even if we don't have a crisis today. And here I wanted to go into what in economics is called an incentive compatibility constraint. There's a structure that more or less, I'm not going to be so rude as to introduce the mathematics, so I will just go through the structure and talk about how these problems work. So we have a government in most macro problems, and the government's problem is to maximize public welfare. And by welfare, we mean just basically try and optimize growth for the aggregate. Try to optimize the utility of growth for the aggregate. And then so in order to do this, the government has some levers, and one big lever is fiscal policy. So while there might be some temptation to lever fiscal policy such that you win elections, for example, engaging in some type of helicopter drop of cash, so people will vote for you. There is also long-term a reason why not to do this, because typically if you look at the long-term welfare, so again this is measured in terms of utility of consumption for the household, you actually don't get such a great result. Why? Well, because if the government engages in a helicopter drop of cash, it can act as a quasi-monetary phenomenon, and it can cause near-term inflation. So if you do this, sure, maybe you can inflate away debt longer term, but that's not really the best thing for the household. So here we have the divide. If we can ensure that the temptation is smaller than the enforcement cost, then we have a valid incentive compatibility constraint. If, on the other hand, the enforcement cost is too little, then the government may give way to temptation. And in these repeated games, in these problems, if you cheat once, you cheat forever. So you're not getting your credibility back in a hurry anyway. So then this is the mechanism whereby credibility is lost or gained, and we are still within the framework of this. Credibility as yet has neither been lost or gained, but it can be and it will be going forward. So for example, if we do have a fiscal policy that the bond market views as not credible long term, there may be some reactions. So I'm nearing the end of my remarks, but I wanted to talk a little bit about how prudent fiscal and independent monetary policy can work together. And I don't mean in a prearranged, coordinated way. I'm talking about each type of policy doing what they do best, and working to cushion from shocks. Now, we don't have a shock today, but in the event, for example, we have a 40% downside equity price shock, a temporary one, which would be a 2 to 3 sigma event. Then if we can keep inflation expectations anchored, then monetary policy can be reactive, and we can lessen the shock. So this is what we see in some of these charts. I know they're perhaps labeled in a strange way, but what we have is floating fiscal, so reactive fiscal, so FIS on means reactive fiscal, and then either monetary policy that's reactive, float, or fixed. That's not really fixed. It's like it's in line with baseline, just not reacting to the shock. And by many different indicators that we take a look at, the GDP as a percentage from the base case, debt to GDP, unemployment rate, we get a better outcome if we have the fiscal rules intact and only reactive to the shock, and then we have monetary policy that's able to react as well. Now, where this can't happen is when we have something called fiscal dominance. Now, I know that that term has been used a lot recently in the media, and a lot of it has been kind of in the sense of some sort of market parable. It's not that. Fiscal dominance happens when your institutions fail and you lose control of inflation and you can't even implement a fiscal rule. It's bad news. We are definitely not there yet, and there's plenty of reasons why we don't need to get there. But this slide is all about how we can actually have a pretty functional reactive policy, even in times of crisis, so long as fiscal and monetary policy do their jobs. So fiscal policy, long-term responsibility, monetary policy, we are looking at inflation and laser focused on keeping prices stable. So that's it for my comments. Thank you.
Excuse me. Thank you, Naomi-san, for a dazzling presentation. Just quickly, you said fiscal credibility has not been lost yet, but it will be going forward. Did you mean it will be, this is inevitable, or do you mean it could be?
So what I meant is fiscal credibility has not been fully kind of tested and gone through that whole incentive compatibility constraint process. So I think we're still at the point where where the fiscal credibility can be lost or gained. Okay. So it hasn't fully been lost, it hasn't fully been tested and gained yet. That remains before us.
Okay, thank you. Okay, if you would give us your views, please feel free to enlarge the discussion to a more international dimension as far as bond markets are concerned, if you wish. Go ahead, please.
Well, thank you very much. I will focus on the international implications of the tempers in the teacup of Japanese bonds we have seen. So number one, I just follow up from Naomi's statement that fiscal credibility in Japan has not been lost. In my view, it may be the case, but it definitely has been put under the scrutiny and has been put under question. And the sudden rise in bond yields in the past month, in my view, is the adjustment of the risk premium to discount for further deterioration of the fiscal situation and question about the debt sustainability of Japan going forward, particularly after the victory of Takechi. So what I try to say is that this prospect of deterioration of the fiscal discipline, pushing bond yields higher in Japan, and given the interconnectedness in international bond markets, happens in a situation where the fragility of the international system is in a weaker position now compared to what we saw before the global financial crisis 50 years ago. And that is the concern that I want to raise. Basically, if government bond yield in Japan continue to rise, at some point it will upset the equilibrium situation we have now, where Japanese institutions have invested hugely in international securities, particularly in US dollar denominated securities. Right now, we have a kind of holding structure of Japanese government bonds, 50% Bank of Japan, and then largely insurance companies, pension funds, and Japanese banks. We are also seeing changes in the structure of holdings, with Bank of Japan beginning to do quantitative tightening to normalize monetary policy. They may slow the pace of tightening because of the threat of bond yields rising, but they are still in the QT mode. That is, they will be less and less a key factor in absorbing new JGB issuance going forward. The Japanese insurance companies have reduced their buying of JGB, and also pension funds face a very interesting situation whereby as yields increases, their negative duration gap is reduced. In other words, the liability that they have will have lower duration as interest rate rise, and therefore they have less need to buy long-term government bonds to hedge their long-term liabilities. So basically, that means more pressure, more opportunity, or more demand will be put on Japanese banks to absorb any new JGB issuance, more than the traditional big holders like central bank or pension funds. And since Japanese banks are very heavily exposed to international securities, particularly US dollar securities, overall international institutions have about $15 to $16 trillion exposure to US dollar assets. And Japanese institutions, banks, insurance companies, and pension funds, about $6 trillion. That means Japanese banks will have to really rebalance their portfolio and basically make room to absorb more JGB by liquidating their dollar bond holdings. And I think that is one of the channels of transmission of the turmoil in Japanese bond market to international markets. We have a brief development of that in January, but if the fiscal credibility comes into question again, we should expect more. The next point is that given this withdrawal or repatriation of capital from overseas back to Japan by Japanese banks, it will upset the equilibrium, particularly impacting US dollar funding markets. We have seen very close correlation between the movement in Japanese government bond yields, the 30 bond yields or the 10-year bond yields over the past 2 years, with the volatility and pressure in the US dollar funding market as measured by the spread between the secure overnight financing rate and the effective Fed funds rate. And therefore, going forward, if we see another episode of sustained increase in Japanese government bonds, we should expect some pressure in the US dollar funding market. And that is really the key to financial stability at this point, because not only more US players, particularly hedge funds, are very leveraged in terms of their investment, depending on US dollar funding, the repo market to fund their leverage position. But international players are also depending on US funding market as well, particularly connected through the currency swap market. Basically, Japanese banks, as I said, have huge exposure in US dollar bond portfolio. And without a national funding base, they rely on wholesale currency swap to fund those dollar assets. 30% of their wholesale funding is in US dollar. And therefore, any turmoil transmitting from Japanese government bonds to US Treasury market, to US funding market, to currency swap market will upset the whole table gap. So basically the two key trades that I monitor is the basis trade carried out by hedge fund in the US, which is a huge entity now, almost $13 trillion. That's the asset under management of the hedge fund industry in the US. They are now leveraged more than 8 times, which is the highest in the history of data being collected, higher than the leverage position they were prior to the global financial crisis. And therefore, any downward turn forcing them to unwind their basis trade, that is long US Treasury cash, short US Treasury futures, would really cause turmoil in the US market, transmitting elsewhere. From a Japan point of view, you mentioned the yen-based carry trades. Again, if we see sustained rise in Japanese interest rate, reflecting fiscal stimulation, coupled with some tightening of central bank policy, that policy mix would basically cause the yen to appreciate from a weak position we have now. And that, again, will undo the yen-based carry trade, creating more turmoil in the international markets. So basically, what we have in mind is that if we have further pressure in the Japanese government bond markets, it can easily transmit and cause more turmoil elsewhere via the US dollar funding market. And the problem is exacerbated by the fact that hedge funds, even banks, private credit funds are very highly leveraged in the US and therefore, and also elsewhere. And therefore, if the market begin to unwind, the leverage will cause the loss to be quite significant in the short term. And on top of that, we are, because of the geopolitical tension with the America First policy of President Donald Trump, we are at the point where the kind of policy coordination that the G20 were able to do in the beginning of the global financial crisis by working together, coordinating economic, trade, and fiscal monetary policies to sustain economic growth and to pacify the market crisis cannot be taken for granted. People will ask if the US government will weaponize the degree of financial assistance, the cross-currency swap that they have done to the major central banks that really have to calm down the market crisis 15 years ago. That will be expected to happen as a matter of course. So there will be a big question marks about that global financial stability safety net. So to conclude, we look into Japan to see if what we saw in January will be repeated and more sustained fashion. Because if that is the case, then I think the following crisis would be more testing and could be more severe than what we had expected. Thank you.
Okay, so I think we'll need to come back over some of those points later, but first, Jesper, if you would give your presentation, please.
Yes, and thank you, Naomi. Thank you, for the excellent presentations in the beginning. I must say, I'm always puzzled, how the rest of the world looks at Japan and looks at Japan as the source of all the problems that they actually made themselves. And it's always remarkable to me how little. It's almost like how people don't talk about generalities, but actually don't look at the facts. And the facts are manifold. First of all, if you actually look at the great specter of repatriation, there's only 3 times when Japan actually did repatriate money, and this was after major disasters. After the Kobe earthquake in 1995, the insurance companies did exactly what you're supposed to do, which is when your cash claims in your home currency go up because of a natural disaster, you liquidate some of your liquid portfolio, which is your treasuries. right? The second one was, during the Fukushima disaster in 2011, a very brief period of about 3 months of repatriation, again, to raise cash for the insurance claims that were coming due. And then, of course, the last one was during the Corona crisis, when again, there were liquidity needs here. There is absolutely no evidence, if you look through the data, of repatriation happening when interest rates differentials between America and Japan widen, or narrow. I'm not talking about the day-to-day or week-to-week movements, but really, on the month-to-month movements here. The second thing is, yes, it's very exciting to worry about Japan's fiscal policy, but again, I think the facts would help. Last year, the Japanese government issued 41 trillion of new debt. This year, the budget is looking to raise 29 trillion. And even if you were to fund the 5 trillion yen of the sales tax reduction for food, that would get you to 34 trillion yen. So actually, as Naomi pointed out with all the charts, you actually find that the primary deficit is more or less in surplus, and that actually it is very, very difficult to point to any form of fiscal recklessness when you actually look at the amount of bonds that, is hitting the Japanese government market. The second point, or the third point, is that, we are in a period of yoi kinri josho, of good increases in interest rates. I mean, the remarkable thing is 3 years ago, 2.5 years ago, Japanese 10-year bond yields were 0. Today, they're at over 2%. And nothing bad has happened. In fact, quite the opposite. The Japanese financial institutions, the Japanese banks, and the Japanese insurance companies are reaping record profits. It's not a zero-sum gain. Yes, some people, the debtors, the Ministry of Finance, is a potential loser as its interest costs go up, but the private sector on net, particularly the financial institutions, is actually a net positive of that. And by the way, that's true for Mr. and Mrs. Watanabe as well, because you find that for the first time in 40 years, you find that asset income, interest income, is actually starting to go up. It's very low, because interest rates are still very low, but there is a positive offset, certainly for the domestic economy here in Japan, as indeed the cost of debt normalizes. And this is very, very important. I think that, what is going on is not a question of fiscal irresponsibility, but it is the reality of the Japanese economy after 30 years of mild deflation and of, interest rates being suppressed very aggressively, at around 0 for a long time, of that actually normalizing. Yesterday, we got GDP statistics. For the last year, for 2025, Japan's nominal GDP grew by 4.5%. Nominal income for Mr. and Mrs. Watanabe grew by 3.5%. A 10-year bond yield that last year was still basically below 2%, that does not make economic sense. It's exactly the kind of normalization that Naomi pointed out in her charts. And like I said, there are adjustments to this, but these adjustments are, primarily positive, particularly for the private sector, for the financial intermediaries, and, for, the Japanese household sector. So I think, that, what we're really facing is not a question. So the point I'm trying to make is that, there's like, daily moves in fixed income markets, always very exciting if you're a trader, but actually if you step back, what stands out is how remarkably smooth the adjustment after 30 years of zero interest rates, right, to basically a 10-year government bond, now yielding 2.25%, how smooth that adjustment overall has been. And by the way, that's true for the foreign exchange market as well, because, it's hardly exciting, when you look back over 40 years to see that over the last basically 24 months, dollar yen certainly has been trading between 145 and 155, very, very narrow. This is not you know, the kind of volatility that certainly when I was young, you know, we had to endure. So bottom line here is, yes, there are obviously issues that you want to talk about, you know, but I think that give credit where credit is due, there is a remarkable adjustment, and the smoothness of the adjustment is actually something that stands out to me. Now, the worrying aspect, right, is obviously that, number one, the inflation constraint is still not fully recognized, in my personal opinion, you know, by the Bank of Japan. And I think that, you know, it's not just US Treasury Secretary Scott Bessent, but I think making the argument that the Bank of Japan is behind the curve, that indeed all that the government bond market here is doing is pricing that more interest rate increases are going to be needed, and that this idea of the neutral policy rate, right, somewhere between, you know, 1 and 1.5%, you know, which until 6-7 months ago, you know, most economists would like to put forward, that's complete nonsense. Because if you've got a potential growth rate of 1% in the Japanese economy, you've got an inflation target of 2%, that would suggest that the neutral policy rate is somewhere around 3%. You can pretend to be more precise, but nobody really knows. So I think that adjustment of actually normalizing the Japanese policy rates to get closer, you know, to the neutral rate, that I think is an adjustment that we're going to be facing. The final point I was going to make, which nobody talked about, which is good, you know, is that we should also think about what happens to the equity market. Because obviously, as domestic interest rates go up, it becomes more attractive to buy domestic fixed income rather than domestic equities. Right now, the price earnings multiple in Japan is around 20 times. So that would suggest an earnings yield of around 5% against a 10-year yield of around 2.25. When is the point when the gap between the earnings yield and, you know, the risk-free rate becomes so narrow that it does actually make sense to buy Japanese fixed income? You know, that I think is a much more interesting question rather than to worry about, you know, whether Japan is going to continue to recycle its current account surplus. Anyway, let me stop here. Thank you.
Okay. Thank you, Jesper. We'll come back to your final point about equity versus fixed interest. But I'd like to ask, before we do anything else, one question, which is, certainly Prime Minister Takaichi has appeared to moderate her fiscal expansion ambitions, just as she's sought to tamp down fears about possible tensions between Japan and China. But of course, you know, she would do that, wouldn't she, in the run-up to the election? She's only been in office now for a very short time. She has a huge majority. So what are the risks of the fiscal expansionism? We'll leave China aside for the moment. What are the risks of Takaichi's fiscal expansionism rising on the back of her huge victory? Naomi-san, you take that first, if you would.
Certainly, yes. Now, I would just recalling the framework that I laid out on temptation versus enforcement. I would say that winning such a large mandate increases the cost of deviating. So before, when the government was a minority, then the cost, the hurdle of really engaging in some sort of kind of populist expansionary regime was very low. Now the cost is much higher. The thing that Takaichi now has the room to do is use that large political capital, the political mandate, to make the tough choices for tomorrow. And once again, we're not dealing with an imminent fiscal crisis. We're dealing with signaling, important signaling from the market. There has to be a dialogue between the government and the JGB market. So all that Prime Minister Takaichi has to do is signal to the market that we are not going to have irresponsible fiscal policy longer term. It's fully possible. So I would argue, in sum, that winning a large mandate actually decreases the risk of irresponsible fiscal policy.
Well, that's comforting, Jesper.
The risk of, you know, some sort of Venezuela fiscal policy happening is zero. You know, Takaichi has a her principal problem is that she's cast, particularly in the foreign media, as Abe 2.0. And she's a lot of things she's not. She's Abeism in terms of the basic ideological background. In terms of economic policy, she's one of the most studious and rational actors in the world. The first thing that she will give you a lecture on, and I've received that lecture, is that the output gap is closed. Wow, you're a politician, you know what the output gap is. When Abe showed up, the output gap was minus 3-4%. So you did need pedal to the metal money and fiscal policy. Note the pragmatism. In the foreign press, she was supposed to, basically handcuff BOJ Governor Ueda and prevent him from ever doing anything. 2 months after she was elected, Governor Ueda raised interest rates, and she practically went out of her way to thank him for doing so. So I think that, this conflict, and I think there is people focus, particularly in the foreign world, people focus way too much on simplistic macroeconomic models, while what actually is going on is that the reallocation of fixed resources, i.e. of the Japanese budget, right, taking away policy support from areas such as zombie support, for example, and we can talk about the details if you're interested, and reallocating it, for example, into defense. I think there's much more interesting things going on in terms of the actual reallocation of the line item by line item budgets, than actually meets the eye. And like I said, just look at the numbers. The numbers, this is not a massively expansionary budget. And even if we do get, this cut in the food taxes, I think that, the overall budget numbers are nowhere near on a runaway target. The second point I would want to make, I actually think that, the mandate that she has actually increases the degree of freedom for the Bank of Japan to accelerate its hiking in interest rates. Because yes, there are strategic decisions that the Japanese government will have to take. And the biggest one, obviously, is the trade-off between guns and butter. Defense spending is something, that structurally is gonna be increasing. Yeah. And how is that gonna be happening? How much can you take away by reducing, payouts to the pensioners, payouts to the healthcare system? How prepared are the Japanese people to actually tolerate, further increases in the, what is it called, jikufutan, out-of-pocket expense, for healthcare? These are going to be big issues, going forward. But I think that, let's also, just my final point is, this is the only G7 government where there is complete coordination between the Treasury, the Prime Minister's office, and the central bank. Right? This doesn't exist anywhere else in the world. So from this perspective, I think the West, the United States, Europe in particular, have a lot to learn from how smoothly policy and how responsive policy is actually being implemented here in Japan, as opposed to some of the recklessness and let's fire the Fed chairman type of approaches that other countries are taking.
I wonder which other countries you're thinking of.
Well, the EU guy should be fired, but that's a different story. Sorry.
Yes.
Can I invite your views on this? I mean, are you reassured by this? And is this rather sanguine view shared, do you think, on Wall Street, or are there still real fears that Takeichi will run amok, as we say?
Thank you very much, and I appreciate the final points that Naomi and Jasper presented, particularly more kind of reallocation of resources within the budgetary envelope, from supporting zombie to defense spending, which is interesting because more should be written about that. But basically, reflecting someone from overseas, looking into the speeches, statement, big numbers, macro dimension in Japan, I simply cannot see the numbers being added up, because one, they want to raise defense spending to 2% of GDP soon, and then to 3% of GDP within the next 5 years. They want to increase supporting for key high-tech sectors, semiconductors, and so on. They want to address the affordability problem for Japan by cutting the tax on food and so on. And interest rate will be increased so that new bond issuance will be funded with higher cost of interest. So the interest payment will be higher. So you add everything up. It is difficult for me to see how the budget deficit can be contained. The question is, will it be pushed upward very strongly in a kind of irresponsible policy stand, or is it being managed and presented as something under control? And that is a question that I raise. I don't have any conclusion yet, but my point is that if the surprise that we saw last month happen again, and it is sustained rather than short-lived, then the consequence could be more severe and more longer lasting than what we saw briefly in January. But the whole point of my presentation is really more on the fragility of the international financial system because of the high degree of leverage that many financial institutions have been involved in, which make it very fragile and very, very difficult to contain if something happened.
Okay. Jesper is burning to ask you a question.
No, I was just going to thank you and look on the fragility or the potential fragility of the international system. That's wonderful. But just to hone it in on Japan, could you have you ever seen a solvency or liquidity crisis in a country that has a very large current account surplus?
No, we haven't talked about insolvency. We are really talking about, again, reallocation of fund from one market to another that then would have implication and impact on the rest of the international government bond market, particularly U.S. Treasury. So it's not just a question of solvency. It is more a question of allocating of the fund. The flow of fund will have implication for the rest of the world.
Okay. I think before we go any further, let's see if there are any questions online. Any questions online? I don't see any. I can see lots of names online, people listening earnestly but not asking questions. So, okay, well, can I just turn, Nabe-san, did you want to make a comment there or not? No?
I'm fine, moving forward.
Okay, all right. Hung, just turning to a wider international dimension for a moment, you mentioned that in the event of another crisis, G20 coordination could certainly not be guaranteed on the scale that it was at the time of the global financial crisis. But can you just say a bit more about that, about whether you think, I mean, there are obviously problems beyond Japan in the fiscal system, in the bond markets and so on. How optimistic or pessimistic are you about another crisis occurring at any time in the foreseeable future? Briefly.
Well, before that, I just also want to bring another point. We really talk about Japan because that is the title of today's session. Yeah. But also people should all keep in mind the challenges facing the U.S. Treasury in the next year or two, because they do face a very huge challenge in managing their funding requirement. They face higher budget deficit, 1.9 trillion or more a year. They face a wave of redemption of the bonds that they issued 4 or 5 years ago, particularly during the COVID era. So going forward, they have to manage gross funding requirement per year up to $14-15 trillion. That is budget deficit plus rollover of maturing debt 4, 5, 6 years ago, now at higher interest rate. And therefore, I think that something could go wrong in the U.S. Treasury is equally or if not more likely than what we have talked about in the JGB market. And that, of course, can be a direct source of instability. And then, again, it will be transmitted internationally as well. So with that in mind, what I really say is that with the weaponization of economic relationship, with trade relationship, we can easily envision the same degree of weaponization of financial relationship that the U.S. has vis-a-vis other countries. If we have something like the global financial crisis happening, requiring the Fed to provide unlimited or promise of unlimited supply of U.S. dollar liquidity to stabilize financial markets. That may not come just as a matter of fact, like we saw 15 years ago, but with a lot of political condition, a lot of requirements, a lot of demand, and could take longer and more difficult to see it happening. So that uncertainty in itself will add to the severity and the difficulty of the next global financial crisis.
Okay. Yes.
Yes, I do have a comment on that. And I think it's necessary to acknowledge the point of potential of resilience to shocks and potential financial contagion. And I think it's maybe necessary to separate the questions of whether, are we prone to crisis today? Are we in a crisis situation today versus resilience to potential shocks? If we take a look at Japan's fiscal accounts, no, there's nothing that signals crisis today. It's just that markets are interconnected, and it's probably not possible to look at Japan in a complete vacuum. If we take a look at equity markets, I think we mentioned equity markets earlier, it would be ill-advised to ignore the relationship, or at least the correlation, between global equity markets, especially U.S. equity markets, and the Japanese market. We see a lot of the cross-border flows coming in. We see a lot of the yen carry trades, yen-funded risk asset purchases going to global equities. So, are we fully ready for any type of shock? Well, probably nowhere in the world is fully ready for that type of shock. And at least based on my own research, I can say that it's very possible that equity markets specifically are very good at pricing things, assuming that nothing changes. So, what I did was a model based on state contingent claims. What they're not so good at pricing is transition probabilities. Not very good at pricing those. So assuming that we actually transition into a shock state, it's very possible that current equity markets, and I don't mean just Japan equities, I mean global equities, it's very possible that we're not ready for that type of shock, and that's not priced in.
Okay.
Can I just sort of, just on that point, the thing that has changed is that, and this is where Japan is nice, because in Japan it's just the most obvious one. We're growing in nominal terms at 4 or 5%. The pie is growing. And when the pie is growing, good stuff happens. You don't run out of money. In the 1990s, when Japan's pie was shrinking, even in nominal terms, that's much more dangerous, because you and I running any form of financial institution, if our clients are withdrawing money, which means the pie is shrinking, then we become forced sellers. Now the pie is growing, so it's not forced sellers. So at some point, maybe the cycle is going to start to turn. But the interesting thing is that the global economy, and this includes the United States, it doesn't include Germany, but basically, the good part of Europe, i.e. where the sun is shining, is also growing very, very strongly. The global net saving surplus is growing. It's not falling. And so from that perspective, I think, the opportunity set that, for example, is being created here in Japan. Naomi mentioned, there's growing interest in Japan. It's not just private equity firms. Everybody and their brother is looking at the growing liquidity in Japan's debt markets. I can now buy mezzanine debt, which I couldn't do before. I can now buy venture capital debt. I can now buy private debt. So all of this supply is actually being met by a pool of capital that continues to grow, because the global economy actually continues to be growing. And, the United States, is actually at the forefront of that, growing extremely strongly, much stronger than anybody would have anticipated, given, the policies that the presidents announced or ramped through about a year ago. So I'm not saying this is a rosy world, and it's finance and it's capitalism, and we're supposed to have crisis in capitalism. The question is that crisis coming? Is that crisis imminent? And I think that the answer to that is no.
Okay. What are just quickly, the inflationary impact of this growing pool of finance or liquidity, if you wish.
Well, like I said, I mean, I have this fight with Governor Ueda. It's like, I think you're so far behind the curve. You should hike rates by 150 basis points in one swoop. You know, the system would actually take it, I think. Right now, if you hike, I mean, they're not going to do that. Don't worry. It's not going to happen. But I think, you know, like, where is neutral? Neutral is not 1.5% in Japan. Neutral is 3%.
Okay. Okay, any questions online? No, I can't see any for the moment. Defence spending, I mean, as the China threat is supposed to be growing, or at least is played up more and more, presumably Japan's temptation to spend a lot more on defence is going to rise. Do you think that's a real threat or danger? And if so, what are the implications for finance? Naomi-san first.
So I think, first of all, if we take a look at the fiscal balance, the allocation of the budget is less of an issue. But the nice thing about fiscal policy is that not only can you create a resilient fiscal policy for the long term, but what you can do is, unlike monetary policy, which is very blunt, you can subsidize things that you like and tax behaviors that you don't. So you know, the internal allocation is probably going to be such that the government has the potential to design policies that might contribute to greater productivity in the future. Now, I'm not sure whether just, you know, headline defense spending is going to add or detract from total factor productivity, but some of what we've seen in terms of industrial policy that tends to get associated with defense, and you know, across many countries, if we have some dual-use technologies developed, that could feasibly contribute to longer-term productivity, and that's not only in Japan. That's in Europe as well, and the U.S. has been known to embrace that type of industrial policy as well, although it's less certain whether it will continue to do so going forward.
Yes,
Look, I mean, Japan is way more clever than that. You know, in the sense of that, you know, exactly as Naomi pointed, you know, the question that you have, I mean, when you talk to Takaichi, I mean, the question is like, how do you want to make Komatsu a better company with increasing defense spending? That's really the number one concern. It's not about, like, you know, having more missiles on the borderline, yada-da. It's about, okay, how do we actually unleash, you know, the multipliers so that domestic companies, whether they're startups or whether they're established companies, that they actually become better companies. And it's not going to be through the budget. Let me give you an example. A couple of years ago, they launched a 10 trillion yen fund to advance science education in Japan, right? And that's working. There is grants being given, you know, grants being handed out. Tokyo University is very angry because for the second year running, they didn't get any of the grants. You know, but be it as it may, there's real money that is flowing into science and into technology transfer, you know, that didn't exist 3 or 4 years ago. But there's no line item budget of $10 trillion. This is an endowment that is set up, right, in a public-private partnership that actually works very, very well. And I think with defense spending, you'll see exactly the same thing. Line item, which by the Japanese government, by the way, is way smarter than where am I from? Than the Germans. Why would you commit to, you know, a line item budgetary target on defense when actually public-private partnerships, you know, allow you to unleash dual-use technology, scientific collaboration, industrial collaboration, you know, in a for-profit venture, right, that doesn't have to be bankrolled in its entirety, you know, by the taxpayer. And I think that's exactly what you're seeing, you know, going forward here in Japan. So will Japan's independent, sovereign ability to defend itself grow? The answer is absolutely yes. And by the way, just to be blunt, and don't get this the wrong way, you said, oh, because of the threat of China. It's the threat of America that is unleashing this, because the trust that America is going to be here to defend Japan against the threat from China, you know, that trust is unfortunately being eroded, right? Oops.
Okay. Yeah, I mean, what you're whispering or saying in my ear makes a lot of sense, but who is whispering primarily in Prime Minister Takaichi's ear? Are you confident that she has good advice and is willing to heed that advice. I really don't know, actually. I mean, she's not obviously a financial expert any more than I am, but is she, to what extent is she acting from her own, feelings, gut feelings, if you like, and to what extent do you think she is willing to listen to and seek expert views? Naomi.
Well, I think that to some extent, leaders might be defined by how they actually utilize and defend institutions that help foster growth in their own countries, as well as who they delegate to. Because as you mentioned, no one person can know everything. So I don't really have an opinion as to whether the current advisors are adequate or not, but what I would say is that it is a very strong signal if at some point there were an advisory body, a pretty high profile, transparent, accountable advisory body that was well balanced and also well versed in both economics as well as other aspects. That showed greater accountability to the people. I think that would be a very strong signal if that happened. I think also what would be another strong signal is if there were some sort of fiscal rule that could be embraced. It doesn't, until recently, it was primary balance surplus in any given year, and that has been taken away, and there's a bit of a vacuum there. What's going to replace it? It would be helpful if there was some sort of definition around what credibility means.
That's very interesting, and such a mechanism does not exist at the moment, in your view.
Well, prior it was the primary balance surplus, and then so that seems to have been removed as
Right.
the primary as the rule. So nothing has really taken its place. It can, but it hasn't been defined yet.
Interesting. Well, Jesper, please.
It's difficult to. The answer is what is the answer? The answer is that the curiosity and seeking of opinions, is a very strong one in her. She is not and has zero interest in building a body of official advisors around her. She's very interested in having an open mind. And actually does have very frequent contact with people who have interesting ideas to bring forward. I think more important for her is that the delegation to the people with a specific portfolio she has a very, very strong sense of. Katayama-san is the finance minister. She is, that's her job. To figure out whether the strategic ambiguity on is there or is there not a primary balance target, how that is going to be communicated. Katayama-san's communication with, her counterparts are very smooth and very, very good and very intense. So it's different, you're right. Abe 2.0 had a team of 12 people who basically would steal horses for him and would go out to battle. Now, that was when Japan was in a time of acute crisis. Today, Japan is in a lot of things, but it is not a time of acute crisis. There are issues, there are pressures, there are shifting global realities. But this is a time where you should move slowly and, with deep contemplation rather than with radical action.
I'm sorry, there's one point that I feel is very important to make. So discretion wins no points in terms of fiscal credibility. In fact, if we look at the literature on incentive compatibility constraints, discretion undermines the incentive compatibility constraints. So that's one point that I wanted to make very clear, and what role the overriding discretion with process, with credibility, has in terms of fiscal credibility.
Sorry, stupid
But that's
question,
just a
could
model
you, Could
constraint.
you make that a little bit more simple for people like me?
Sure.
I didn't-
Yes. Certainly. So, when we model whether a fiscal policy is credible or not, it detracts from the credibility if you have a high rate of discretionary decision making by one policymaker. That makes them less credible in, I guess, this type of quantification. If you actually have an announced framework that the policymaker sticks to or not, it's more possible to measure it.
Oh, okay.
Yeah, but,
Hung, looking
just a
looking in
model
from outside again, the international perspective. I mean, what we've heard today is really, on the whole, quite positive. Do you think that confidence in Takaichi overseas, especially in the United States, is where now? Is it where is it? Oh, you're offline. Yeah, sorry, your microphone.
Okay, sorry. Yeah.
Yeah.
From outside looking in, basically, I will monitor it closely to see if the fiscal policy will be rolled out in the way that Naomi and Jasper described, or in a way that the market will be sensitive to. So I think that remains to be seen.
Okay, diplomatic answer. Thank you. Okay, questions in the room. I'm sure someone has a question. No questions? Well, I think, are there any points, any issues that we've lost here sight of? I mean, we've talked about allocation of budgets and so on. Oh, yes, just I'd like to come back to your point about equity markets, and at some point the fixed income return looks attractive relative to equity return. I think that's what you're saying. I mean, but we're not at that point yet. I mean, how imminent is that possibility?
Well, so I think that, like, look, I mean, the 10-year forward, right? So you can buy a 10-year rate 10 years forward, right? Which is what professionals do. It's already at 5.5%. So I can, if I'm an insurance company, I can buy effectively. I can buy a 10-year yield, right, at 5.5%. You're getting close, to where the valuation of the equity market relative to the domestic debt market, is starting to be normalized. It's no longer the Warren Buffett, oh my God, this is super cheap. It's now fair value, be my guest. And it's nice. Japan is for financial players, Japan is superbly exciting because unlike the United States, where you've had basically 30, 40, 50 years of free market capitalism, and you can backtest all your data, all your strategies around, very deep, very liquid markets. In Japan, we can't do that because for the last 30 years, we've had a market where, the debt market certainly was dominated and suppressed by the Bank of Japan, capping, the 10-year bond yield at zero. So, we're in new territory in terms of, like, what is my mean reversion? What does that actually mean? Because this is the first 3 years that I am actually in a market, which is very, very exciting. So I think from that perspective, I think that the trade-off, people, in my opinion, people focus way too much about the trade-off between Japanese interest rates and global capital markets. Where yes, the Japanese institutions, the Japanese asset owners are important players, but it's kind of like, oh my God, China sells all its treasuries and swaps them into gold, therefore the US bond market is going to collapse. Well, it didn't, because the US bond market is unbelievably deep. And that's the same, if whatever the GPIF is going to be doing going forward. To me, the much more interesting, correlation and the causation is going to be between domestic fixed income markets in Japan and the equity market here, because you are at the beginning of 2026, for the first time in 30 years, you are at a point where this starts to look like it's no longer value. And that's, I think, where it gets interesting.
Okay.
He's got a question.
Oh, yes, I'm sorry. Please come up to the microphone. Give your name, please, and ask your question. Your name and your affiliation, as it were.
Hello, my name is Michael, Rainer Michael Price. I have a question that the crisis, I mean, this topic is about crisis. Could we actually have it the other way around, that we can have a crisis of underinvestment from the world into Japan?
Thank you.
That is still not really understood yet?
Yeah. Which is obviously, as somebody who actively invests in the Japanese markets, that is the real crisis. The world is underinvested, but so are the Japanese, which is very interesting, right? And Naomi can speak to that. That's her business, right? But I mean, the reality of whether it is domestic institutions or whether it is domestic asset owners, so private households or their intermediaries, their institutions, for all intents and purposes, they're very underinvested, right, in their own asset markets.
Do you want to comment on that, please?
Certainly. I guess when I think of crisis, I typically think of nonlinear moves that actually are not predictable and cause reactions that might otherwise not be expected, both by markets as well as policymakers. So I would not call underinvestment in Japan a crisis, although equally I would not deny that if we compare, for example, Japanese household balance sheets to the US's or even Europe's, then Japan has a much lower rate of investment in its own markets, and notably the equity market. So even if this isn't a crisis, it's a problem, or it's something that might have a solution. What is the solution? Well, we have to actually discover what optimal allocation actually is. And in my opinion, we're still early days. That work hasn't fully been done yet, but it can. And perhaps ultimately we can arrive with time to an optimal allocation. I just don't expect that to suddenly happen tomorrow.
Just, go ahead, please.
Yeah, but I completely agree with those two statements, because it strengthened my point that if we go from the current equilibrium in terms of international capital allocation and asset exposure, if you say Japan is underinvested and you expect Japanese households, institutions to begin to correct that by investing more within Japan, that means they have to withdraw from their current exposure overseas. So
no, they don't. They've got no, they don't. They've got 25% of their assets are in cash.
Right. Okay.
So it's not. I'm not stealing from Peter to pay for Paul because I've got lazy Susan, under my mattress.
It remains to be seen, because if it depends on their liquidity preference. If they still want to invest in Japanese equities and Japanese bond, but still have 25% cash, they have to liquidate overseas investment, and that is empirical questions that we have to see.
Okay.
But it is not inconsistent with my thesis that there will be movement of funds very quickly where we are today to favor and at the expense of overseas markets.
Interesting. Okay, briefly.
I mean, just for 30 seconds, right? For the U.S. households, right, the asset income yield is around 6.7%. Japan, it's now 1.3%. Hooray,
Right.
It's no longer close to zero, right? So there's a lot of things to do. The final point I want to make, the real underinvestment is corporate Japan in its primary asset, which is human capital, right? The underpayment versus productivity gains in the labor market, right? The gap between labor productivity for listed companies and what listed companies actually pay their people, that gap here is almost twice as high as it is in the United States of America. And the United States of America is not known to be kind to its workers. The Japanese are really not kind to their workers.
Okay.
And it's interesting, by the way, that little Takaichi, that the Prime Minister of Japan, for the first time in about 10 years, is the first prime minister who isn't, talking about higher wage rates.
Yeah. Okay. I think it was Prime Minister Kishida who talked about making Japan an asset management nation. And an interesting comment was made last week by Hiroshi Nakaso, who is the head of something called Tokyo Fin City. But he said he was signing a memorandum of understanding with the Frankfurt mine financial center, I guess. And he said that Japan and Germany have lessons to teach the world in this regard, in the priorities in allocation of financial assets. In other words, perhaps more focus on industrial development and so on, industrial policy. So, I mean, does Japan really have anything to teach the world in this regard? Because, you know, when we look at Wall Street and we look at the Magnificent Seven, we look at the huge amounts of capitalization taken up by those stocks, it doesn't look as though a very intelligent allocation of capital is being made. So does Japan, and maybe Germany, have something to teach the world in this regard?
Yes, so it's funny that you mentioned Prime Minister Kishida, because I think Prime Minister Kishida also mentioned, or one of his policies described a new type of capitalism. So it's very possible that, you know, Japan is a capitalist economy, so is the United States. The United States has been, by some measures, very, very successful. For example, it's most recently been the only major economy to grow above potential after the pandemic. But does that mean that it's going to be a lasting success forever? Not necessarily. It probably has to do with the quality of the underlying institutions. So insofar as Japan has historically been able to invest in its industries and develop an industrial policy, and by the way, even in the darkest days of the last decades, Japan's manufacturing was still pretty competitive. It was just the rest of the economy that was very low productivity. And I've broken this down and measured this. Now, I guess we're in reflation. The opportunity, Japan is at a critical juncture, and it very well can show a different way to do things that can be very, very successful long term. And it may not just be adopting the American model. It may be capitalism, but it may be slightly different, and certainly a change from what has come before. Until now, the shareholder, especially during deflation, the shareholder occupied maybe a very low standing among stakeholders in Japan. And while Japan is loath to get rid of its stakeholder capitalism model, the shareholder has climbed up a little bit more. So perhaps we have some sort of equitable model where the shareholder can get adequately compensated for the risk taken without fully putting too much emphasis on only rewarding the shareholder, and also looking long term, not just quarter to quarter, for how we can enhance national productivity.
Very interesting. Yes, but you want perhaps from the German perspective?
No, it's funny because I think the debate has moved on. I mean, the shareholder yield of Japan is now twice that of Wall Street. You know, the question going forward, you know, is that clearly global governance is being challenged by the White House. They're very aggressive by introducing state capitalism, right? So let me give you two concrete examples. The Department of War in the United States now has a $200 billion fund that is mandated to buy off American allies, you know, dual-use technology by taking stakes in companies. So these people were in town a couple of months ago, and they want to buy 5, 6, 7, 8, 9, 10% stakes of Japanese companies. Now, if I'm a board member, or if I'm a shareholder of a Japanese specialized electronics company that the US Department of War wants to buy a 10% stake in, is this a good thing or a bad thing? This is where it gets interesting, right? So I think, you know, Japan and Germany to some extent, but I think Germany doesn't have the spine, nor the capital will, nor the economic strengths, nor the political vision, nor the soccer team to actually make it happen. Apologies. No, but you know, but in all seriousness, you know, these are the challenges, you know, where Japan is coming through. The second example, look at the $550 billion investment fund. Yeah. You know, no Japanese company wants to be part of this. Yeah. But since the announcement of that $550 billion agreement, as it were, there've been about $25 billion of Japan capital flows, private sector, right, investing in the United States of America outside of that scheme because they don't want to be part of a scheme that has questionable economics, perhaps, I do not know, right? But more importantly, has highly, highly questionable governance. And that's, I think, where it's very, very interesting that Japan's corporate governance has actually evolved to teach the world, right, how actually stand up against your government. Oops.
Hung, I'm sure you have a brief comment on that. Yep.
Well, I think Jasper said something about state capitalism coming into play in the US. I do not think it's state capitalism. It is more personalized capitalism.
The Intel stake, he doesn't have a veto, right?
Right.
I mean, just but you're right. I mean, you can blame everything on Trump, but I think there's some deeper forces that are going on in the name of national security.
Okay. All right. Well, if there are no more questions online, it is actually 5 minutes before our closing time. Gives me time to thank our panelists. Hung, thank you very much for your contribution. It's early evening there, yes, so it's not an outlandish time. Thank you, Naomi-san. Thank you, Jesper. Please join me in thanking our panelists.